Today we're going to go through home biology, the basics of buying a home. We're going to break this down into 3 different groups. The loan approval process, the people who work on your loan, and then what it's like to go under contract from contract to close. Let's start with the loan approval process. There's 4 main areas to a loan approval: credit, assets, debt, and income. That's it. You can remember it with the acronym CADI if you like Cadillacs. Caddy, that's how I do it. Credit, assets, debt, and income. So let's start with credit. Go right down the spread there. Credit really simply is, what are the credit scores of all of the borrowers who are going to be on the loan? The credit scores are not averaged. So if there's multiple people on a loan, and one person has an 800 credit score and the other person has a 650 credit score, by definition, they're going to use 650. Reason being, if the 800 person comes off the loan at any time, for whatever reason, that loan itself is stuck with the 650 borrower. So they're going to always default. There's no averaging. Credit scores, generally speaking, you want to have credit that's above 680 because that gives you the best chance to dictate what you want to do on a loan and how much you want to put down, etc. You can usually get loan approvals for upwards of 620. You can also get approvals for credit scores of below 620, but I'd argue that you should probably work on your credit before you buy a house if your credit's lower than 620. $740 or higher is a premium score. We take from all 3 bureaus. You don't do anything with that. You just check authorization when you do an application to do credit, and we get it. It's not the same as Credit Karma. That is a different deal. Credit Karma has their own scores. Mortgage applications have an entirely different score, so don't think that they're the same. Okay, let's move on to assets. Assets are really simply, where is the money going to come from for down payment and closing costs? So usually what you'd like to do is you'd like to know what's in liquid checking and liquid savings accounts, this is your bank accounts, and then what you have in retirement, both IRA and 401k. 401ks, some people don't know this, but you can do a loan to yourself without penalty from your 401k for the purpose of buying a primary residence, and that is getting to be more of a popular option for people. And finally, you can get a gift from family. That happens on about a quarter of the purchases for first-time home buyers are getting some sort of gift from family members. So you can do that as well. But that's what you do on assets. Debt is really simply coming back to your credit report. What do you have for debt? Do you have student loans? Do you have a car note? Do you have a current mortgage? Have you co-signed for anybody else? Is that showing up on your credit report? So we take into account all of those things when we look at how much debt somebody has in their credit report. Just know this, it's way better to have more in assets than it is to have less debt. We'd much prefer that somebody has, so let's say $20,000 in their bank account and $10,000 in credit card debt versus $10,000 in assets and no credit card debt. I know it's weird to think about, but on the credit card debt, we're going to count the minimum payments. So for the purpose of buying, you want to have more in cash and you do try to reduce your debt. So anyway, that's debt. The last section is income. And income really simply is, how do you make your money? Is it salary? Is it hourly, which is different than salary? Is it commission income? Is it bonus income? Is it 1099 income? Are you self-employed? That's that category. So everybody's going to be different there, and just know that you can't count somebody's income unless they're on the loan. So if they got bad credit but great income, everything is in the pool. Everybody in the pool. Everybody's coming in. Everything's coming with credit and income. So you can't count somebody's income who's not on the loan. Okay, so that's the 4 areas of the loan approval process. Now the players. Same thing here. There's 4 different people that work for you when it comes to getting your loan from beginning to end. We'll use them in 4 stages. First stage is the loan officer or the mortgage consultant. I'm like your advocate. I'm like your agent. As you guys most know, I'm a retired professional baseball player. I'm like your agent. So share with me hearts and minds, thoughts and feelings, and we'll go through the process together. You speak to me, you text me, you call me. I am a point of communication, especially heavily up front and heavily in the back. I'm up front, mortgage consultant, first person. Second person is the processor. They are entirely in charge of loan documents. That is their sole job. They don't do anything else. You also talk to them, you email them. You're not going to text them, but you're going to communicate with myself and the processor. That's stage 2. Stage 3 is the underwriter. You won't very likely speak to the underwriter. That's the person that's going to take a look at you on paper. They're going to check the automated risk software that we run up front, and they're going to say, does what we have documentation wise, does it match what these folks are as entered on the application? We'll see what the risk software says. They are the ones that approve your loan, not the loan officer. Loan officer is your advocate. The underwriter is the impartial decision maker, okay? The loan will, generally speaking, stay there for a little bit and bounce back and forth, and I'll get into that in a second, between the processor and underwriter. And then it goes into stage 4, which is the closer. The closer, again, you won't speak with. It is somebody who's gonna send, click send on the money, and they're gonna be the ones that provide the loan officer with your final cash to close, which they're gonna send to you, and you're probably gonna discuss a little bit, and anyway, you won't speak to them too, but that's stage 4. And that stage 4 closer only happens when you are clear to close and done with the underwriting process, okay? So those are the 4 people that deal with your loan and closing it up. That is your team as a buyer, okay. Contract to close. So let's say you sign an agreement and you make an offer and it gets accepted. Okay, so now you've got an accepted offer, you get a contract. Great. Okay, what's the next step? Next step is you're going to go into attorney review. We're in Illinois, so we've got an attorney review period. So the first thing that happens after you do a contract is you're going to do a home inspection. And the home inspection is your first place where you've got an out-of-pocket expense. Expect to pay $250 on average for a home inspection. And they're going to go through the home and they're going to tell you where you at in terms of the cosmetics and the foundation. It's not going to do a value of the property. That's different. That's an appraisal. That's different. But the home inspection is an upfront look at, should we continue to look at this house? Let's hear what the home inspector has to say. They'll generate a report which you keep and don't send to the lender. All the lender really wants to know, what we want to know is, are you still going to go forward with the house? Yes or no? And if the answer is yes, then we'll proceed, okay? So once you've done the home inspection, that's when we'll put in the address into our file. That'll create a whole bunch of regulatory timing things to go off. Picture a factory floor with everybody running all over the place with the sirens blaring. That's what's happening when you put the address into a loan file. And we'll send you disclosures, which you click through and e-sign, and then we move you over into processing. At the same time, we're gonna order an appraisal, which is required by lenders in order to buy a property. So that loan file is going to go over from us in stage 1 to the processor in stage 2. Stage 2 is they're going to take a look at what documents are in there, request anything that's not there that needs to be there for your type of profile on the income side. If they've got enough, they're going to take your loan file and pass it into stage 3 and get into line to be underwritten. After that, it'll come out with an approval or with some extra questions. That's the ideal outcome anyway. And from stage 3 to stage 2, it's going to pinball between stage 2 and stage 3 with clearing all of the conditions that come out of underwriting. Those are the things that the underwriter asks for in order to be completely done and have a clear to close. Once there are no more conditions to clear, it's all clear, you are clear to close. It goes from stage 3 to stage 4, and the closer on the lending side is going to reach out to the title company, which is the referee for the transaction, and the title company and our closer are going to essentially take the same set of numbers. They're going to turn their backs to each other. They're going to figure their numbers and figures. They're going to turn back to each other and they're going to say, what did you get? And they need to match to the penny. Once they do that settlement procedure, they'll have a settled closing package. That settled closing package goes from the lender to the title company to later close your transaction. In the meantime, I'm going to put my hand up when I see that happen and say, can I see the final closing disclosure, the loan document that has your cash to close on it? They're going to send it to me. I'm going to send it to you. We're both going to review it, make sure that it's correct. It can be amended. Sometimes it is amended. And we're going to make sure, are all the credits there? Is everything correct, basically? And are we prepared? When it comes time to bring cash to close, you're always going to want to bring a little bit more than what the cash to close is saying on that document. Reason being that number can change as late as the day of closing, sometimes correctly, because sometimes people make mistakes. You've got lawyers doing math, you've got people that have 30 and 40 files a day that are working. Sometimes people make errors, and you want to make sure that you've got an overfunding of your closing, because title companies, generally speaking, won't take personal checks. They definitely don't take cash. And you want to make sure you've got more than enough there. When I say more than enough, it depends on how much you're bringing for cash to close. Generally speaking, having a cash to close figure, let's say, for example, in the $20,000 range, you might want to have 10% more, 5 to 10% more. If your cash to close is $100,000, you might want to have $10,000 more, give or take. Depends on a lot of different things, but that is, generally speaking, you want to be overfunded and be done, because you don't want to be short on your closing day. Okay, that is your whirlwind first-time homebuyer course. I hope that you loved this segment of Home Biology. Feel free to reach out to me at jody.gerut@phmloans.com. You can also submit an application to me by going to www.jodyggerut.com, so just jodygerut.com. It'll bring you to a Prosperity Home Mortgage page with me on it and Chicago skyline in the background. Click Apply Now, and it rolls from there. It's not a downloadable PDF, it just rolls online. It flows from one place to the other. Thank you so much. If you want to get a hold of me, 630-302-2700, call or text, and I look forward to hearing from you. Take care.